Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. We're going to run through Twitter. A lot of really good information, or at least I think it's good information, is on Twitter, and I'm going to go through all of it with you guys and give you my financial opinions. Again, if you're interested in this type of information, learning deeper, more into how to play this market, you can definitely check out finding-value.com, become a platinum member, use the word discount in the coupon codes, and you can come to the platinum question and answer sessions and see the midweek updates that I do. So let's dive in here. I'm going to give you my opinions around all this. And if you want to follow me, you can follow me at finding_finance. So we talked about natural gas and I talked about weather, how the weather was to blame for inventories not being drawn down. And this is what it is basically. This is the historical heating degree days in winter for the Northern Hemisphere. This is population weighted days, January through February. So very cold days would look something, incredibly cold years where these guys way up here. Incredibly warm years where you don't need to use the heat for natural gas, they're down here. And look where we're at. We are at arguably the second or maybe third lowest heating degree days going all the way back to the early 1970s. That is how warm it has been. Now, this is a big deal because we were investing in natural gas and we were playing what I would say is the average here at about 4,600. That's kind of like average. And 4,600, and we are down way below that. So we have a warm winter, and that's just the way it is. I still would have played it the way I played it, long natural gas, because the downside wasn't too bad. And if they really ate through the inventories over in Europe, if they had a cold winter, it would be a much different price today than what it really is, and ended up being. So the risk reward was there, but it didn't turn out in our favor, and sometimes that's what happens. But I just wanted to show you the extent of how warm it's been through this chart here. Looking at Buffett and Munger, I do think they are some of the best investors, and they take a long-term approach. They don't care for technical analysis. I'm a hybrid. I do the big picture view charting. The short-term stuff is basically much lower probabilities, much more difficult to predict, and I don't play the short term. He says, using volatility as a measure of risk is nuts. Risk to us is 1, the risk of permanent loss of capital, or 2, the risk of inadequate return. And they have to measure that over a long period of time is how they measure it. They've talked a lot about getting into positions and being down 50, 60, 70%. The risk of permanent loss of capital wasn't there, but obviously they had a big drawdown. So a lot of the times they would pile in even more. And then over the long period of time, they would look at the return. So they're not huge market timers, although I think they're pretty decent at market timing. But I just wanted to bring that up of what they consider to be risk versus just volatility. A lot of people think volatility is risk. And I agree with them. I think it's kind of, I don't know. I don't agree with that measurement. It says, articles like this are why any argument about what happens if China dumps USTs is a total canard. China already swapped USTs for a forward supply of agricultural commodities a full decade ago. They've been doing this for 15 plus years across the wide swath of commodities. And I would say when you have to worry is when the entire world does it. When nobody wants to swap for United States treasuries. That's when the real fun begins. And I think it's coming. You're going to see less and less countries buying United States treasury bonds. It says, life is too short to only get paid 26 times a year. I thought that was a good quote. Basically, this is what you get paid if you work at a large corporation. It's, for the most part, 26 times a year. So were home prices going down from 1940 to 2008? Or is there maybe something else besides QE that affects home prices? So this is the federal view of Federal Reserve balance sheets as it came all the way back down. He's talking about QE. And Darth Powell, this guy, I don't know. I look at some of his housing things, and he keeps saying, look at this chart, and he's pretty single-minded, or I don't know. I don't know what to call it. But he says QE was the biggest mistake, the biggest inequality generator outside PPP in history, literally stole the American dream from a generation. And he goes to this housing chart. Federal Reserve manipulates mortgage rates ever lower in order to artificially inflate home prices higher. I hate to say it, but I completely disagree with this statement. Yes, they manipulated mortgage rates higher. Yes, home prices went higher, but they wouldn't go anywhere if there was no demographic to buy them. The demand was already there, and they put gas on the fire. That's what happened. If they did this, right, you could manipulate manipulate interest rates to zero during the crash of 2008 and 9, and guess what would happen? Home prices would not go up like they did. They would go nowhere because there's a glut of homes. So, in my opinion, if you've got a strong housing market, interest rates will go up. That is the inflation is driven from the housing market, which then puts pressure on the bond market to sell off and interest rates to go up. That is the cycle. To say what this guy is saying is to say that he knows nothing about the cycle. That is really literally what he's saying. And he's just saying that there's something else rather than just QE. I completely agree with there's something else. In fact, QE does not drive home prices. It would be a very small percent being driven. The demographic has to be in home buying years. And QE added fuel to that fire because the demographic was there. That's what happened. It says conservative investing with steady savings without expecting miracles is the way to go. And I wanted to read this. This is from Charlie Munger. I think it's a pretty good quote. It says, it's in the nature of stock markets to go way down from time to time. There's no system to avoid bad markets. You can't do it unless you try to time the market, which is a seriously dumb thing to do. Conservative investing with steady savings without expecting miracles is the way to go. So I've gotten a lot of slack by certain individuals on certain platforms because my strategy that I developed and that I'm using and deploying is to buy the bottom of 2020 in the commodity bull market that is coming. I bought a bunch of different things, and I've been accumulating as I go on pullbacks. I am not trying to time a bad market, a recession or a drawdown. I'm going to ride through it, and I'm going to ride through it as long as the credit expansion cycle is there, which is the demographic driving the home buying. That's all I'm doing. I'm literally sitting in these stocks and accumulating at what I think are good areas to accumulate in. This would agree with Charlie Munger. Now, these guys that think they can time all this stuff. Oh, well, I'm going to time the top. I'm going to use technical analysis. I'm going to do all this stuff. Guys, I did that last time. Not going to do it again. I'm just going to ride this thing. And Charlie, I think, is in agreement with that. And I'm looking at this like, maybe, depending on how the oil supply goes, maybe we never get out of it. I don't know. Maybe we get into a deficit that we can't get out of. And the only way I'll say with oil is we are at 100, I think it's 102 million barrels a day. My question to everyone is, if you've got a doubling factor of maybe 7 to 10 years, maybe it's 10 years or something like that, do you think that we can go to 200 million barrels a day of oil production? If the answer is no, if you don't think there's any way that we could go to 200 million barrels a day, I don't think there is. That means that you are basically saying that in the next 10, 11, 12 years, where we are expecting a doubling of oil production or a doubling of energy consumption, that cannot be met with our current oil reserves and the ability to flow that amount of oil out of those reserves. I don't know if that's possible, 200 million barrels over the next 10 or 12 years to do another doubling. So where's all that energy going to come from? I mean, obviously a lot of people are going to say nuclear, and I agree with that. But I'm just trying to put a framework, and it's like, if we can't do that, if we can't even increase it maybe 20% even, which I don't even know if we can go to 120 million barrels a day, then why don't I just invest in oil in these markets with oil? I mean, it's not too bad. It's not too hard, and that's the way that I view it. Sit in it, wait for the tightness to come. It's going to be volatile as all heck if we get a pullback, because we are going to maybe get a recession at some point. I'm just going to sit in it, and I'll buy more if we get a recession. It's that simple. It says pending home sales rise by most since June 2020 as housing market looks to rebound. Wait. I thought we were in a housing crash. Why are pending home sales rising the most since June of 2020 as the housing market looks to rebound? I noticed that a lot of homes in my area are all pending sale. There's very few homes on the market right now where I live, at least the ones that I would want to purchase, which are generally 3-car garages. But I just peruse and I look and I don't see much out there. We got Stacy here, says, if the housing market is crashing, it better get started because I'm not feeling it yet. Inventory is dropping, and I'm just starting to run into multiple offers, no contingencies again. Wait a minute, guys. I thought we were crashing. Why is this seasonality kicking in where the housing market generally picks up around January, February, and we're starting to heat up again? So it says pending home sales crush expectations and rise 8.1% in January. Mortgage rates are above 7%, recession fears are spreading, and mortgage demand is at 25-year lows. Yet, the housing market continues to hold up. Is this the most resilient housing market of all time? Why is this? The demographic. Mainly me, remember, I've been pretty bullish on housing because of the demographic. I said, let's wait and see. Let's check the seasonality. There we go. There's the seasonality for everybody. It's getting stronger. Now, I'm not calling that we're going to get some gigantic housing market boom where prices just shoot up 20, 30% in a year. I'm just saying that the housing market is more resilient than what the majority of people out there that only watch prices and prices only. And when they see the price go down a little bit, they see the price go down, they're like, oh, it's a crash, it's a crash, it's a crash. It's like, guys, calm down. Seasonality. We need to watch. We need to see it. We need 2 down years in a row to say that this thing's knocked out. So I'm not convinced yet. I'm not convinced. So we've got TAN here. TAN is our solar ETF. It says, could break that upper golden trend line this time around. Big green support lost. Still, now lower low, however. No lower low, however. And I'm just looking at this. I watch charting, but I think this will break higher. Why do I think? Because it is energy, and I think governments are going to throw a bunch of money at it. Now, could we do a detour a little bit lower? Definitely we could. Overall, though, I'm not a big fan of solar. I don't think they're ever going to make much money. But if governments are going to throw money at it, they could. If they throw money at it. But it's all going to be subsidized by fossil fuels and higher energy returning generations of power. Now here's the pandemic boom towns of Austin, Seattle, Phoenix, and San Francisco will all experience double-digit price declines as an increase of available homes surpasses demand. The bank's analyst said in a note to clients last Thursday obtained by Insider. That's what they say. But we've seen the market starting to firm up. So we'll see how that plays out. So here's Happy Wine. He says, yep, if the Fed didn't want to create a death spiral, they would have kept the Fed funds rate at or below 2%. The Fed decided instead to allow death spiral to occur, which will only mean worse inflation later as deficits are monetized even harder. So what he means by this is when your interest rates go above a certain level, say 2%, your interest payments start to get out of control. And it starts to spiral where they do deficit spending to pay the interest payments on the debt, which then sparks more interest payments and more deficit spending, which goes into a spiral. And we are in potentially that type of death spiral already. We're already moving towards that. So we'll see what happens there. Now, here's another cool one. It says, focus on process over outcome. So it says, here's out of my control. What others think of me, what others say, the beliefs of others, the past, the future, so on. What's in my control is a positive attitude, inner peace, what I eat and how healthy I stay, my relationships with friends and family, productivity, and so forth. What I think you can look at this, and what I was thinking about, talking about, is this can be your strategy. This is my strategy. And then there's a bunch of things outside of your control that the markets have around you. Your strategy should work in any sort of market environment where you're focusing on the value in the markets. So you can control what companies you buy, what position size you put on it. You can control the sectors you are looking at and are diving into. You can control your emotions. You can control how long you hold it, so on and so forth. Out of your control, something happens where things sell off because of bad news. You could have a pullback in the markets like a recession. You can have these certain things that happen that are out of your control. But if you have a good strategy and it's within your control and you can navigate the markets with that strategy, which is a good strategy, you can work through the things that are out of your control in investing. Take a longer time frame. So here's South Africa, right? Everyone knows I'm a huge platinum, especially physical metals, platinum guy. And I said, I'm not going in South Africa. I don't want to be exposed to the companies in South Africa because I think their electrical grid is crap. So South Africa is 75% of production. Zimbabwe is another 8%, and they're facing similar issues. So Zimbabwe miners say costs, power shortages dampen 2023 growth. Zimbabwe's miners face rising costs and persistent electricity shortages, which will impact the sector's growth prospects next year. So here it comes. Better get ready. I'm locked in, ready to go in platinum. So here's platinum, needs to be much higher. South Africa has collapsed. U.S. Embassy is now informing international travelers to stock up, prepper style, on food and water. Here we go, guys. This is the platinum run that might send us to the moon. And I've been playing it with no companies that are located in that area because I don't like that area. I didn't want to be exposed to it. And everyone always asks me, well, what's the what other investment I can do outside of physical platinum? I'm like, I don't know. Just buy physical. It's guys, physical platinum is, I would say, one of the best investments that you can invest in. This isn't advice by any means. It's my opinion and what I'm doing is your risk is so low with the physical metals that you bypass everything. So what you can literally do, and let's just say we get into a real big squeeze scenario. So if we get into a big squeeze scenario, let's say you buy platinum, and I'm just going to give you a round number, $1,000 an ounce, right? So you own 1 ounce of platinum. You bought that. Let's say it goes to 200 ounces. So 1 ounce of platinum can buy 200 ounces of silver, right? So you go in and then you swap your 1 ounce for 200 ounces of silver. So now you're at 200 ounces. And let's say silver runs to $50 an ounce. That 1 ounce at $1,000 turned into $10,000, which is a 10-bagger. How many stocks do you know and how much risk do you have to take to do what I just did right there? So that is how I look at it. I say, well, if I have the lowest risk thing in the world and all I have to do is sit in it, buy it when it's the cheapest it's ever been against basically every other asset out there, and I can just sit in it and accumulate it. And if something happens to South Africa or Russia, which both countries have problems right now, this could go ballistic because Russia is something like 20 or 30. It's probably about 20. No, it can't be that much. Well, maybe it is. It's about 20%, 15%, 20% of platinum production, 75 from South Africa. Imagine what happens if something happened to Russia as well. There'd be no platinum in the market. And what do you think they're going to want? Do you think people are going to want the mining companies in South Africa? No, you can't invest in Russia. Everyone's going to go after the physical metal. It's going to be crazy, I think. Or could be crazy. Could be crazy. So here's another one with platinum. It says, last time this ratio chart had any kind of very large red positive divergence down at the very lows, a massive bull in mining started. It was 22 years since last time. It should be time again. Platinum often shows the way for big moves. So this is the start of the massive bull in mining here in the early 2000s up to 2008-9. This was that double top with the platinum-palladium ratio. Under disinflationary environments where the housing market goes into a recovery phase, palladium outperforms. We came all the way back down here to ridiculous land of how cheap it is. I bought this entire thing in 2019, 2020, 2021, 2022. I bought the whole bottom here, guys. I cost averaged in. That's how I roll. We're breaking out to the upside, and we could see a big move up, potentially to the upside, where platinum outperforms palladium. So that's what I'm playing, and it's a large bullish positive divergence, just like last time. This is your large positive divergence. We have another one happening right now for your RSI. So yeah, and platinum's cheap against everything, and it's going to outperform. It looks like it's going to outperform silver, gold, palladium, and rhodium. That's all the metals. So here's Cornerstone Analytics. He says, solving problems with problems just results in many, many more problems. The great green fraudsters forced the US and Europe towards an impossible energy transition. Got energy because the world damn sure needs it. Lots of it. And this is a good thread here. This is, and you guys hear me talk about this a lot. It says, if you look to keep expanding and growing our economies, there will be a requisite requirement for more energy. This is your energy consumption versus GDP. Your R squared value is 95% correlated. It's basically the same thing. You can't grow GDP without growing your energy consumption. And if we hit a problem in energy consumption, guess what happens? You get a mismatch between your M2 money supply, which must grow, and your GDP. So therefore, what you can do is you can look at your M2 money supply divided by energy consumption, and that is your inflation rate. And if you have a problem in energy consumption and your M2 money supply has to grow, you're screwed. And that has to grow deals with the deficits and the interest rates and that death spiral cycle that we talked about earlier in this clip. Though these are all intertwined. So what you could see is money is going to have to rotate at energy in a big way because GDP is going to suffer. So I think the biggest opportunities in the markets right now are, and I've said this to the Platinum members many, many times, energy service, energy in general, and physical metals. Because it protects you against all of the largest risks in the system. And here's what's crazy, guys. This is what's crazy. The cheapest spots in the market are those sectors. This is just retarded. It's so fun. So there's that. I'm not going to go through the whole thread. I just wanted to show you that. Now, this is highly important. I completely agree with it. It says the wrong in outcome does not mean wrong in process. Wrong in either does not mean wrong in character. So you can have a right outcome, which means you're right in your outcome, but your reasoning is wrong. That is dangerous as heck. So someone could say natural gas prices fell because of a depression. Wrong answer. Natural gas prices fell because of interest rates. Wrong answer. That's not the right answer. They fell because of the warm weather. The supply and demand of natural gas fell because of warm weather. So the weather was the root cause of natural gas going down. Wasn't it increasing interest rates? Completely false. And if you believe it's increasing interest rates, good luck. And the process The reason that becomes so important with the process is because once you find a correct process, you can put strategies around the process, and then you can accurately track what is important and what is driving the thing that you want for the outcome. A lot of people, even in manufacturing, choose the wrong things to watch. They choose lagging indicators. Lagging indicators get you nothing. That's like someone saying, this guy can't hit curveballs. It's like, yeah, we already know that. If I'm the batter, I know I can't hit curveballs. What you need to do is you need to practice hitting curveballs. It's that kind of easy. So you want to look at leading indicators. So leading indicators are things that will give you a heads up before an outcome happens. So you could be looking at weather, but weather might be a little bit more difficult to predict for natural gas consumption. But we could look at the growth of countries, their consumption of energy. All right, so if they're in the middle of their S curves, India and China, and we are getting short in energy, we saw a little glimpse of what happens if you're short in energy in Europe. Inflation goes rocketing out of control if you've got the combination of expanding money supply and shortage of energy, because that's what we had. So what I could do is, if I think that the entire world's going to be short energy in the next 5 or 10 years, well, I could just buy a bunch of energy and sit in it. Is energy cheap at this time? Yes. I don't see what the problem is then. Why is it so hard to sit in something even though you could have 30, 40% pullbacks and volatility? Buy in the pullbacks, ride this thing on higher. Not advice, just what I'm doing. But I've got a lot of really good companies. If you want to join the Platinum membership, you can check those out. And if you guys like this content, definitely give me a thumbs up, subscribe to the channel, and I'll end it there. We'll catch you next time. This is Finding Value.